it. And ultimately, I do think gold will go higher than anyone thinks possible. I think we are moving to, forever it was about keeping gold low because of Gibson's paradox and the inverse relationship between real interest rates to make the dollar and the bond market and all the Western currencies and bond markets seem strong. It may just flip-flop and go the other direction to debase the currency, to pay off debt, to back the bond market, to back the settlement system in the other parts of the world. Rising gold to me is guaranteed almost. Nothing is guaranteed, but highly probable. But it won't be easy. If it were easy, then everyone who's keen on accumulating it would be crowded out of their trade.
As trust in paper money continues to decline, gold is gaining traction. We are witnessing a more profound change in the way global markets perceive money, debt, and long-term stability rather than merely another brief surge. Big organizations are starting to reconsider gold's function as a vital component of a possible new financial system, rather than just as a safe haven. A prominent voice in the precious metals industry, Andy Schetman, thinks this change is already happening. He cites significant players' increasing anticipation that gold might hit between $6,000 and $7,000, with $6,500 serving as a potential ceiling before the subsequent increase. However, he contends that in more dire circumstances like a significant decline in trust in the US dollar or a shift to a system backed by gold prices would rise well above that, possibly to levels that few investors are ready for. The reasoning is simple but powerful. Gold could be used to rebalance the global financial system by valuing debt in terms of ounces rather than depreciating currencies.
And a lot of the things I've talked about with you, BRICS and de-dollarization, I mean, they've all been a leap of faith backed by a progression of facts, but there's a gap between the facts and the outcome. You have to, either you're stupid enough or brave enough or just feel like you're supposed to say what you think, which I do, all of the above. Maybe I am stupid to say it, but I do think a lot of these things are happening right under our noses. And when Donald Trump Jr. wrote that, I'm like, wow, that's interesting. So maybe I wasn't so far off by saying it. And ultimately, I do think gold will go higher than anyone thinks possible. I think we are moving to, forever it was about keeping gold low because of Gibson's paradox and the inverse relationship between real interest rates to make the dollar and the bond market and all the Western currencies and bond markets seem strong. It may just flip-flop and go the other direction to debase the currency, to pay off debt, to back the bond market, to back the settlement system in the other parts of the world. Rising gold to me is guaranteed almost. Nothing is guaranteed, but highly probable. But it won't be easy. If it were easy, then everyone who's keen on accumulating it would be crowded out of their trade. And so I just think it will be a progression, slow progression. It's too dangerous to just go bang like that. So let it go up, and have some volatility. And then when we get up here, well, let's talk about revaluing it after everyone notices it, that it's already way up there. We'll revalue it, and it will be much easier than revaluing it from 2,500 or 3,000 or even 5,000. Let's let it get a little higher before that happens. I don't know if they'll revalue it then. I don't think you have to, because these treasuries that she would talk about are redeemable in gold, that Judy talks about, would be redeemable in gold at a future time. The price would be stipulated. You get $20 million worth of gold. Well, as Van Eck funds came out and said recently, Van Eck, not me, Van Eck said, we think gold could go as high as like $139,000 if we lost the reserve status. And if you have a $20 million bond that's due in 20 years, well, you owe 4,000 ounces of gold. Today at 5,000 ounces, at 139,000, it's like 110 ounces. So, does it have to happen right away? No. But will it happen if the treasuries are back and redeemable in gold? You bet your bottom dollar it will. How it happens, how fast it happens, how orderly it happens, those are all guesses. But let's see if Judy was right. If she is right, well, geez, then doing these podcasts come July 5th are going to be amazing.
About a gold revaluation as we need to stabilize a system, a potential reset. Do you believe that this is now more and more likely?
Well, it certainly seems that way. I mean, first of all, in terms of debt, it's right out in front of us. They don't even care anymore. We'll just raise the debt ceiling or we'll dismiss what Doge said. And, they came up with $2 trillion. We'll do a couple $100 billion, which is 30 hours of spending by the U.S. government, some stupid number. The point of it is that they don't care much about debt until they have no choice to care about it. The fiscal irresponsibility is grotesque. And, they just continue to dig the hole deeper and deeper and deeper. And that's what gold is telling you. It's telling you that we're not rich. The U.S. is in any way. It's telling you that the debt has gotten so absurd that even Fort Knox barely registers against it, assuming the gold really is there. Fort Knox and the New York Fed and the Denver Mint and all of the places it's held that should be on the stockpile list. But that's the point. It's that if you're going to debase the currency, if you are going to bring back manufacturing and sell your products to the world, it has to be, according to Triffin's dilemma, abandon the world reserve currency, debase the dollar. You don't debase the dollar against the dollar index. You debase it against gold, which is the one neutral asset that is neutral against every other currency on the planet. You don't measure it against currencies that constantly devalue against your dollar. It's a melting ice cube that you're measuring it against. It doesn't work. It's not fair. It's not right. You measure it against gold. It's the barometer by which all currencies are measured, or all assets are measured. And it's been that way forever. And, in everything we talk about, life is getting more expensive in the United States. Measure those things in dollars. And you will see that every asset you can think of is going down. It's deflating against gold. It's massively inflating against dollars. And that's the real measuring stick, not the dollar index. So yes, ultimately, and guys like Luke Gromen, who I don't know if there's anyone smarter in this industry, talks about his belief, and which I agree with, would be a preferred organic growth, which we've seen. Of course, there's been a little bit of a pullback here and consolidation to balance out sentiment. You have to do that in bull markets. They're natural, they're healthy. We haven't seen a breaking of the trend. We're seeing higher highs. We're seeing consolidation, and then it goes up, but we see consolidation. That's fine. But it would be best if we could see gold much higher. A lot of the commercial banks are saying north of 6,000 very soon. I remember Luke saying he thought it would go 6,000, 7,000. I remember Jeffries, that used to be one of the primary distributors for the Mint, used to be Jeffries Beige. I think they're just Jeffries now. But they were saying, I think 6,500 was their number before it paused. But you see it get up to those numbers, and then you revalued it, which is an accounting gimmick. But yes, it would massively devalue the dollar, and it would revalue gold. It would give the Treasury a huge boost of income. Every $4,000 increase in the price of gold gives the Treasury general account free and clear $1 trillion based upon the number of ounces we have, which is an accounting gimmick. The Fed would print it and give it to the Treasury, debase the dollar even more. And as gold becomes more expensive in dollars, the currency is being devalued, period. It would do the same thing to other countries. It would benefit other countries too. So I don't know how much pushback you would get. And maybe that's why the majority of central banks hold gold on a balance sheet called the gold revaluation account. That is the name of it. And the majority of central banks around the world hold it in that name on their balance sheet. Do I think it will be revalued? I think the answer is yes. I think it will be organically revalued as much as possible. And if they have no choice but to revalue gold for national security, I could see them doing it absolutely.
Rising debt and heavy government spending are putting pressure on the financial system, and gold is acting like a warning signal. As spending increases and long-term risks are ignored, currencies tend to lose value. This is why gold prices often rise when confidence in fiat money weakens. The current situation is more than a short-term shift. Deeper fundamental shifts in the global economy are driving gold's long-term upward trend. Gold prices are currently predicted by many major organizations to reach between $6,000 and $7,000 in the near future, with a potential stop at $6,500 before rising further. In more extreme scenarios, such as major changes to the global reserve system or a shift toward gold-backed settlements, gold prices could rise much further. Some models even suggest values as high as $139,000 if global debt is revalued in terms of gold instead of paper currencies. This would effectively reduce government debt when measured in gold.
And even though the United States, as you once very intuitively and astutely mentioned to me, that, well, isn't the BIS a Western institution? It is, but it's not just the United States. All of Europe classified silver critical. And so did, in essence, China, more or less. And so when you have the world that is accumulating something and the price is set in your backyard and you control it, Well, you're supposed to play by the same set of rules. And if you have the ability to mess with the rules like that, I think it aggravates the powers that be. And in doing so, they blew up the refining industry in this country. Maybe that has something to do with exports going to Switzerland. And my thought, my belief, it's just a belief, that it's not going to China to buy rare earths, it's going to Switzerland to be refined because we can't do it fast enough. Would be my guess. Not sure. And it would leave too much of a footprint here. Well, what if the U.S. refiners are too log jammed? And in an effort to throw people off the trail on all of this, you're seeing gold go out as an export, but it would show up the same way, whether it was fully refined gold going to China for payment or it was gold doré going to Switzerland for refining, would show up the same way. And the imports continue every single month. Let me see if I have the March numbers here real quick. I bet I do. And again, this is just 1 month, but what we're seeing is the same thing every single month. So as far as what has come in so far, we have seen, there's silver. Where is gold? Here we go. As far as gold is concerned, in the month of March, sorry, don't mean to throw you off here. Here we go. COMEX gold deliveries. Total gold March deliveries so far, this would have been through yesterday, are up to 9,698 contracts, or 969,800 ounces have been delivered so far. And we saw 104,844 ounces shipped out. And I believe that was on Friday. Pretty sure about that. 104,844 ounces shipped out of COMEX. Well, where's it going? Who's taking possession of 105,000 ounces? But we're seeing the same thing month over month over month. There's still half a month left, and we've seen almost 1 million ounces of silver delivered to COMEX so far this year. So, or this month rather, for March. But this has been the same thing we've seen every month. So it's still coming in. But what is going out into who is debatable. And is it coincidence that this is happening same time that we've worked out these deals with Venezuela? I don't know. It just seems kind of that way to me. When I first started talking with you 3-4 years ago, all of the deliveries or the repatriations from the Bank of England and the New York Fed, lack of trust. Why are we seeing deliveries and lots of that metal leaving the exchanges, which would render it very illiquid? If you have truckloads of 1,000-ounce bars that have left COMEX, you have a real hard time selling that stuff unless you don't trust who's holding it, and the rules by which they're playing. It's a lack of trust to me. And it was very right in your face. Yeah, there were glitches, and yeah, we raised margins so high that everyone got strangled out, and yeah, we did it. What are you going to do about it? And at the same time, you're seeing wicked deliveries with all of these. So that's the important part to remember, is that in times of stress, price is not where the stress shows up first. It shows up in deliveries, like the deliveries we're seeing to Shanghai. There's stress there. In a normal market, that arbitrage would have ended a long time ago, because the big traders would have bought here, sold in Hong Kong, which is a COMEX contract, an exchange for physical, and have it driven over by truck to the exchange in Shanghai. That arbitrage would have been done in days, but it's now going on weeks and months. Why? Because they're choking on dollars. They're willing to pay a much higher price for it. Please give it to us. A $13 charge right now, it's about 13%. So that's somewhere in the neighborhood of about $13-14. At the same time, there's the VAT tax that they are responsible for paying when it leaves the Shanghai market. They're willing to pay about a 25% premium, but to the trader who has the ability to buy here and sell there, you sell 10 million ounces at a $13 profit, you just made $130 million. Have a nice day. So that arbitrage is real. I just think that what you are seeing is the West's desperate attempt to suppress the real value of silver, which, by the way, the European Union classified critical mineral a year and a half ago. China in November said, we're the largest second largest producer of silver in the world. Everything that we produce, we're keeping at home for domestic use. We're going to mitigate supply or exports, they said in January, as coming back to kind of retaliate against United States calling it critical, you got the whole world is looking at silver as something very important, and the price is set in one place, New York. And if you're going to screw with the price in New York, you're going to get called out maybe now when it's a different game than it was before this recognition by much of the world that silver was more important than the dollar price that it is supposed to be valued at. I think if I had to guess, that's why they said it in the manner that they did. It's unusual. I felt the same way when I read it.
Andy Schetman explains that what we're seeing in the precious metals market, especially with gold and silver, isn't normal. He points out that large amounts of physical metal are leaving exchanges like COMEX, which makes the market less liquid and harder to trade. In a healthy market, metal usually stays within the system and moves efficiently between buyers and sellers. But when big quantities are being taken out and held physically, it signals something deeper: a growing lack of trust. He also highlights that stress in the market doesn't always show up in price first, it shows up in physical movement. For example, there's a big price difference between Western markets and places like Shanghai, where buyers are willing to pay a much higher premium for silver. Normally, traders would quickly take advantage of this price gap and balance things out, but that hasn't been happening. Instead, the gap has lasted for weeks or even months. Schetman believes this is because demand for real, physical metal is so strong that buyers are willing to pay extra just to secure it, even if it doesn't make perfect financial sense on paper. He also talks about unusual flows of gold, large amounts coming into exchanges, but also significant amounts leaving, with unclear destinations. This raises more questions about who is taking delivery and why. He believes some of this could be tied to global trade deals, resource strategies, or even efforts to refine gold outside the US due to capacity limits. While he admits some of this is speculation, the overall pattern shows that something important is happening behind the scenes.